What's up, everybody? According to Redfin's analysis of over 90 million homes in December, the national housing market is now worth $47.5 trillion after a 5.3% increase over the last year. Even with these higher interest rates and seemingly lower demand, home values are still rising. They attribute this to three primary reasons, one of which is the shortage of homes for sale. The other two we'll dive into a little more later. Last week, we spoke about the fact that boomers are staying in their houses longer, therefore contributing to the inventory problem. In an analysis published this week by Freddie Mac, there will be 9.2 million fewer baby boomer homeowner households by 2035. This could be the silver tsunami the industry insiders have been talking about as baby boomers start to sell their homes, flooding the market with inventory. So today, we're going to take a look at two articles, one by Redfin titled, "The U.S. Housing Market Gained $2 trillion in Value Over the Last Year" by Katz and Chen, and an article for Resiclub by Lance Lambert titled, "Freddie Mac, the Silver Tsunami will be a gradual reduction as 9 million boomers exit the housing market by 2035. To see what the housing market looks like moving forward. And as usual, I will chime in with my opinion as well. So let's dive right in. The U.S. housing market gained $2.4 trillion over the last year, bringing its value to $47.5 trillion, according to an analysis by the Redfin estimate of over 90 million U.S. residential properties as of December 2023. In percentage terms, the total value of U.S. homes increased 5.3% from a year earlier in December, the biggest increase in 11 months, and was up 13.3%, $5.6 trillion, from 2 years earlier. The authors of the report, data journalist Katz and head of the economics team Chen, wrote, "The largest increase came from more affordable metros like Newark, New Jersey, which rose 12.8% over the last year to $359.6 billion as of December, a larger gain than any other metro." Next, you have New Haven, Connecticut, where value of homes jumped 11.9%. Camden, New Jersey, Charleston, South Carolina, and Elgin, Illinois all saw their total value of homes rise more than 10%. Places like Newark and Camden are likely seeing home values jump, in part because they're attracting demand from people who are priced out of New York and can now work remotely. Midwestern metros like Milwaukee and Grand Rapids are experiencing home value gains for a similar reason. They're affordable, and when mortgage rates and home prices are elevated, demand for affordable homes goes up. The consensus is that in 2023, a lot of companies established a hybrid status quo where you could work remotely a few days and just come into the office the other days, therefore allowing these more affordable metros to prosper. This makes sense then why the more unaffordable metros like New York City and New Orleans, or the pandemic boomtowns like Boise, Idaho, and Austin, Texas, are seeing home value declines or very modest home value increases. These metros are either already too expensive or an influx of out-of-towners caused these home values to skyrocket during the pandemic. Redfin reports that the total value of homes in urban areas jumped 3.6% year over year to roughly $10 trillion. In the suburbs, the values jumped 5.6% to roughly $29 trillion. And in rural areas, the values jumped 6.3% to $7.4 trillion. This is even with the increase in interest rates, which is exacerbating the affordability crisis. Redfin gives three reasons why home values keep rising. Reason number one, there's a shortage of homes for sale. As we know, many homeowners are hesitant to put their homes on the market and give up their super low interest rate to then go buy something with a much higher rate. With little inventory, buyers are competing for those good homes that are on the market. And by good homes, I mean those homes that are priced right and show well. With competition, the prices start escalating, therefore increasing home values. Reason number two, home values hit a low about a year ago. The total number of homes was nearing a trough at the end of 2022 because the market cooled so dramatically as a result of the mortgage rate shock, which is part of the reason year-over-year growth at the end of 2023 was so large. And reason number three, more homes were built. While America is grappling with an inventory shortage, more homes are still being built. which contributed to the gain in value last year. Redfin's analysis includes roughly 96 million homes, up from 95 million as of December 2022, an increase that was fueled by new construction. America's homeowners are sitting pretty. They're holding a massive amount of housing wealth despite lackluster demand from buyers because home values skyrocketed during the pandemic and now a supply shortage is preventing those values from falling, said Redfin economics research lead Chen Zhao. Prospective buyers aren't as lucky. The combination of elevated mortgage rates, high home prices, and a limited pool of homes for sale means home ownership is about as unaffordable as ever. One bright spot for buyers is that mortgage rates should start declining before the end of 2024. We have seen forecasters predict that mortgage rates will go down this year, but so far they're still above 7% according to Mortgage News Daily. So this easing in affordability hasn't really happened yet when it comes to interest rates. Which brings us to inventory. Could the silver tsunami the industry insiders have been talking about as aging boomers look to sell their homes be the answer to our inventory problem? There will be 9.2 fewer baby boomer homeowner households by 2035, according to an analysis published this week by Freddie Mac. Lambert reports that while the economists at Freddie Mac do believe the number of baby boomer homeowner households will be reduced by 32 million in 2022 to 23 million in 2035, they don't anticipate it picking up steam for a few more years. They say this so-called silver tsunami will be more of a gradual reduction. Over the next 5 years, the decline is more modest, and we will only see a reduction of 2.7 million households by 2028. In this sense, the silver tsunami is more like a tide, with a gradual reduction phasing in over several years. While the number of people aging out of home ownership will increase in the coming years, it's more of an upward sloping trend than a disruptive spike, wrote Freddie Mac economists in the report. Freddie Mac only expects a 300,000 net decline this year of baby boomer homeowner households. This annual decline will accelerate pretty much every year for the rest of the decade. In 2027, Freddie Mac expects a 600,000 net decline in baby boomer homeowner households. In 2031, Freddie Mac expects a 900,000 net decline in baby boomer households. And in 2035, Freddie Mac expects a 1.2 million net decline in baby boomer homeowner households. So how does this baby boomer sell-off impact the US housing market? Lambert writes that for at least the next few years, Freddie Mac believes that the housing demand from Gen Z and millennials will compensate for the baby boomer households. In our October 2023 outlook, we presented estimates showing that there were as many as 2 million potential additional households in the millennial generation. Along with increases from Gen Z, total housing demand over the next few years is likely to continue to increase even as the boomers continue to exit the market. Over at least the next 5 years, we expect the increase in the young adult homeowner households to more than offset the decline in boomer homeowner households, wrote the Freddie Mac economists. But not everybody agrees that the housing market will continue to increase in value as the boomers exit the markets. Nick Shaw, the CEO of Home LLC, told Resiclub that while we, Home LLC, are bullish about home prices in the 2020s, we are still bearish about home prices in the long term unless immigration compensates for declining birth rates. In the 2030s, housing demand will start falling because Gen Zs will make a smaller cohort than millennials, plus will face a steeper affordability challenge. At the same time, supply will increase as boomers age. The good news in today's market is that new listings of U.S. homes for sale rose 13% year over year for the 4 weeks ending February 25th, the biggest increase in nearly 3 years, according to Redfin's latest housing market update. Active listings are flat from a year ago, marking the first time in 9 months the total number of homes for sale hasn't declined. This all indicates that the total number of inventory is finally improving. Unfortunately, mortgage rates are still really high. The average 30-year fixed mortgage rate was 7.15% on February 28th, up from 6.92% a month earlier, according to Mortgage News Daily. which has caused pending sales to drop 8% year over year, the biggest decline since October of 2022. The median days on the market is 48 days, down 3 days from a year ago. 23.6% of homes still sold above their list price, up from 22% a year ago. 37.9% of the homes sold in the first 2 weeks, up from 36% a year ago. And 5.6% of the homes did have a price drop, up 1.6 points from a year ago. All of this tells me that we are seeing the same story. With low inventory, whether it's the boomers' fault for staying in their homes longer or the institutional investors' fault for gobbling up inventory, prices will remain high in most of our country. Where I am in the DC area, good homes are still selling in multiple offers going way above the asking price. And by good homes, I mean those that show well and are priced right. One of my colleagues just had a house just last week sell for $300,000 over the asking price with 12 offers. And the house was listed in the high 800s. So that to me is just crazy for today in 2024. But we know that real estate is very localized, so what's happening here in my market can be very different than what's happening where you live. If you believe Mark Fleming, the chief economist at First American, a Fortune 500 company, home price appreciation is a thing of the past. We discussed Fleming's theory in last week's video, so if you missed that, definitely check that out next. Thanks for watching. I do appreciate it. Bye!